Several weeks ago, Dr. Michel Leonard, adjunct faculty member at New York University's Economics Department and the chief economist and data scientist at the III, a sister organization to the Institute's Griffith Foundation, sat down with me to discuss the impact of inflation on insurance. And it's a pleasure to welcome him back to our microphones for a forward looking conversation on the economic outlook ahead and what it may mean for the insurance ecosystem in 2025. Michel, thank you for visiting with me once again to share your insights and economic forecast with the Griffith Foundation's audience of public policymakers.
It's always a pleasure, Frank.
To begin our discussion, can you provide maybe a top-level overview of what the economic outlook ahead may look like? And then thereafter, I'd like to drill down a bit on some of the components influencing your forecast and also to explore what that may mean for various players in the insurance ecosystem.
You know, there's two things about inflation, and if we're looking forward, it's about replacement cost and it's about interest rates. So where, again, do we come from? Very briefly, we're going to be looking forward here. Where do we come from? We come from multiple years of very high replacement costs, multiple replacement cost increases than overall inflation. Is that going to continue? Well, looking forward, overall inflation, and especially inflation for those goods and services that we use in replacing and rebuilding and so forth on the P&C side, those increases in prices are slowing down faster than overall inflation. What does that mean? This means that the last several years, we saw the 2x4 in these walls behind me, plaster walls. We saw those going up 2 or 3 or 4 times, 400%, 500%, from $2 to $10. They've gone down to about 3 right now. And they're going to continue again towards probably like almost where they were before. So the pace of, we've had actual contraction. We're seeing that with autos. So what's going to happen with autos, with used autos and so forth? Those prices have come down. In some cases, they're continuing to come down, and we're going to be in the new normal. I hate that term, you know that, Frank, but in a way, for once, it's useful here. 2024 and 2025, looking to 2025, it's going to be about lower replacement costs in terms of increases. That's still going to be increases, but the pace of them is going to be slower. That's the first element. The second element is the flip side, the relationship between inflation and interest rates. On the interest rate side, the Fed has already started as of Q4, almost of this year, Q4 of 2024, has started to cut interest rates. We've had one. I was at the National Association for Business Economists a couple of weeks ago. Chairman Powell spoke about that. He said 2 more cuts this year in 2024, going to 2025 of 0.25 each, or half a point, 0.5%. Probably more of those also in 2025. What does that mean? That means that there's going to be a resurgence of construction. Homeowners insurance will have underlying growth picking up. Construction, commercial construction, also underlying growth picking up. And then autos. Folks will buy more autos. They'll buy new autos because they're going to be comparatively less expensive than because of interest rates and because of car loans.
Michel, thank you very much. Really appreciate that top-level overview as we look forward. Can we drill down a little bit more with respect to growth scenarios? Could you give us maybe a greater sense for what your prognosis is as we look ahead to 2025?
Yep. I'm going to be very focused here on our industry. So the first area that I want to highlight for your audience is growth for the homeowners lines. For several years, we may recall, we've been in a place where mortgages had peaked in terms of historically inflation-adjusted costs and so forth. The most they've been in 20, 30, 40, 50 years. With those mortgage rates, because of inflation, the Fed is cutting. So going to 2025, mortgage rates are going to come down. It's going to take probably 3 months, 5 months into the year. So halfway through the year, folks are going to start buying homes again because mortgages are going to be more affordable. That's going to start in 2025. It's going to firm up in 2026. We've had challenges. To give you specific numbers, Frank, at one point, homeowners housing starts were down double digits, minus 12%, minus 20% even. Now we're already in the single digits positive, and we're probably going to get into the double digits positive going into 2025. And again, turbocharged into 2026, 2025. It's hard to keep track here. It's already 2024. So into 2025 and turbocharged into 2026 as the rates really pick up in their decrease. So that's the main impact there. More housing starts, volume being pushed up in terms of homeowner lines. And that's going to be good in terms of a variety of areas, such as a policyholder surplus, in terms of being able to look at these higher costs, to absorb these higher costs of extreme weather events and so forth. That's the first area. The second area that I really want to focus on in terms of the personal lines is cars. A lot of the growth, underlying growth, volume growth in the last few years for auto came from purchasing of less expensive cars or of used cars because interest rates were high, so it was more expensive to buy a new car. And also because a lot of the new cars are sold with financing from the manufacturer's financing arms. And a lot of those deals of 0% interest rate over the course of the first 2 or 3 years, they weren't there because interest rates were so high. So the cost of buying a car was much higher, the hurdles to entry. So what we're going to see here is that folks will be willing to buy cars again. And with the new cars, they're probably going to be looking at new insurance policy. They're going to be looking at starting afresh when it comes to their premium for auto rates. And they're probably going to be able, therefore, to see this a bit differently. I think we've all been, whether as consumers or as folks on the side of the industry, we've all been shell-shocked by the cost of homeowners insurance, increasing in homeowners insurance and increasing in auto rates. There's good reasons for that. You and I have talked about those replacement costs again. But the reality is that it's been expensive. Regulators and so on have been hearing from their constituents, whether they're elected or not. This is a conversation that's taking place. So I think with folks buying new homes, with folks buying new autos, new cars, they're going to be starting afresh and probably feeling that they get a better value there.
Thank you, Michel. And to follow up there, perhaps through the lens of insurer solvency, when we think about economic viability, could you connect a couple of dots there, perhaps for our audience as well as we look ahead?
Well, we always start at the III, the Insurance Information Institute, by saying, there's no solvency issue in the industry. That's the first thing. So what really we're looking at is we're healthy, but how healthy are we within the context of being healthy? And that's very important here. There's no correlation between solvency on the insurance side and bankruptcies on the banking side, on the credit union side. So that really provides a cushion from a systemic risk standpoint for the economy. But in terms of the ability of the industry to generate income, lower inflation does mean that we're going to have lower interest rates. So on the investment side, that means that we may have less income from our fixed income investments, which probably will lead us to do some capital gain transaction. But what's important for your audience, again, in terms of these different sources of income, of revenue that allow us to maintain our solvency ratios, what's important there is that we should not be concerned. There is really no reason to be concerned that lower interest rates would lead to lower income. Because over the last 20 years, the industry has really learned, as with many multiplicity of new tools when it comes to fixed income investment instruments, we're able to, as an industry, as most fixed income investors are able to generate more than adequate returns within the context, of course, of a conservative risk appetite. So that will continue to contribute. And then, of course, we have the overall ability there to accept capital. And the fact that overall, the return on investments overall would be a bit lower, it also makes influx of capital, whether it's in the form of cat bonds and so forth, or in the form of reinsurance, it makes that capital more attractive, which again means that we have more capital available to be able to deal with our natural catastrophes.
Michel, thank you very much. I want to pose a final question of you. Given all that we've talked about thus far, what do you believe may be some of the key questions, and you've touched upon a bit of this already, but some of the key questions that public policymakers here in the U.S. will be faced with as we enter 2025, and more precisely, policymakers concerned with risk management and insurance issues?
Well, we have an election coming. That's something important to remember. And even though a lot of regulators are not elected, there may be, at the state level, changes in the political environment. But I would assume that with this change, whichever the results are, folks are consumers, insurance buyers, regulators, and the industry is really focused on affordability and availability. And I think, again, with the shift in interest rates, it's providing an opportunity to look at ways to provide more affordable and more widely available insurance on economically viable terms that respect solvency and so forth. So I think there's an opportunity there to further have this conversation. The industry has been trying to explain itself hey, this is why it's been more expensive and so forth. But I think we're getting an opportunity here, working with regulators and with consumer groups and so forth, to actually say, well, we know why we've come here, we know why it's been more expensive, but how can we work together now to really address affordability and availability?
Dr. Michel Leonard, thank you for joining me. We appreciate you sharing your thoughts on the economic outlook ahead and what it may mean for the insurance ecosystem. Thank you very much.
As always, it's my pleasure, Frank.